presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update for April 8th, 2021. I'm Moe Ansari, President of Compak Asset Management and the Chief Investment Officer. Also, host a market wrap where you've been tuning in for the last 30 plus years, where I do a daily radio broadcast. It is also a podcast that you can come. Simply go to the Apple Store. You can download the app, marketwrapwithmo.com or Market Wrap with Moe Ansari. If you type that in, you can download the free app and get the daily edition of Market Wrap. Great guests, great people from all around the world that we have on the broadcast with their ideas and also my thoughts and observations for the market on a daily basis. That's Market Wrap with Moe every day, 1 o'clock, syndicated nationally. Let's talk a little bit about the webinar. I don't want you to forget, it's going to be on April the 13th. It's not the 14th. We've changed the date. It's a second quarter update, 6 p.m. Pacific time. Right now, you can go to compak.com, 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 click on the button Seminars, and you can register absolutely free, and we will send you the access code. You have to have it to get on to the webinar. It's about an hour and a half where we review the global economic activity. We'll take a look at what's going on. What about inflation? What about interest rates? Is it going to kill the market? We're going to talk about all of that at the next webinar, and that's on the 13th. Today, I'm also going to talk about U.S. markets and get into a lot more detail and the technical analysis of the market. Today, where do we stand? Did we change some of those? I talked about some of those pivot points last week, the pivots, and did we hit those? I'm going to show those to you. Let's start with a pandemic update. Obviously, we hit a high in infections. They're coming down, but they've sort of stabilized here. What we're starting to see now is younger people going to the hospital, younger people who have not been vaccinated, and unfortunately now the B.1.1.7 variant has become the dominant variant, which is the British UK variant as it's called, much more contagious, but it's the younger people. So the mortality rates, thank God, are not going up. They've still stabilized, but we're still at 1,000 people a day that are dying. And we're still at the highs that we were in September of last year. So again, once we get vaccinated, and I believe by the end of this month, we should have, in the middle of this month, anybody who wants to get a vaccine can go get a vaccine. And by the end of this month, I think we will be at a point where we will get to herd immunity. I'll show you the numbers in the webinar in a lot more detail. Again, most of the things that we're seeing, 80% effective, the Moderna and the Pfizer, just the first shot. But if you have, double down, folks. If you have, make sure you get your second shot. That gives you 90% efficacy against the virus, and it is also very effective against the B.1.1.7 and the P.1.7, and we'll talk about the P.1 virus coming out of Brazil, so I'll talk about that in the webinar. Again, if you're old, 65 and older, that's where the unfortunately we saw the mortality, the fatalities is there. If you're less than 50 years, people less than 50 to 64, again, the rates go way down. Anybody 18 to 29, way down, and under 17, obviously, a very low rate. So it is the younger people. Unfortunately, they have not got the vaccine yet. They're getting it, but they are still the ones that are being infected now. The older people, and I'll show you the numbers again. How about going out? Well, if you're 50, 35 and older, you're going out. You're starting to don't feel nervous about going out. Why? Because you've been vaccinated. Under 34, you can see that they're still very nervous. The nervousness is still higher. They fairly are very nervous going out yet. And that's good because they need to protect themselves. Those people need to get vaccinated. Once we get vaccinated, as I said at the last quarter of last year in September, October, I thought this economy is going to roar ahead in the second half of this year. That might be moving up now because we're getting the vaccine done a lot faster, and it was the fight between the vaccine and the virus. Well, the vaccine is winning now, and with that, we are going to see the economy open up. It won't be pre-COVID, It's after COVID. It's going to be different, but I feel that we're getting to that inflection point where we are going to start seeing a lot more mobility, a lot more travel, a lot more people going on vacations, all the pent-up demand that we've seen. But what is that going to do, that pent-up demand? That's the question. How will it impact the economy? I mean, you look at Steam users, these are people who download games and play the games, they're up 66%. Go see apps, they're still up. Online travel is up now 55%. So that's where people were looking for. Live events are still not there. We're seeing card swipes still not quite there. But TSA, it's minus 36 compared to last year. But that number is still way up from where we were. We were down 90%, minus 90%. Now we're 36, about 1 million to 1.5 million traveling. And that's really a good number to get. We're starting to get back to, and by the summer I feel that the airlines will be scrambling to get all the planes in the air and get all the seats will be full, and that's what we're already seeing right now. The reopening, we got to about 73 on the Goldman Sachs reopening score, as it's called, and we were at 100. Obviously, that's pre-COVID. 73 was the highest that we got in August, but here we are now at 78. So we are at a new high, and that is looking great. On a reopening scale, 1 is obviously lockdown, 2 is 10 is fully open. We're at a 6. Last week we were at a 5. So we are moving definitely in the right direction. That's the way I'm looking at this right now as we reopen United States, but we need the global economy also going. Europe has got a problem. And that is bureaucracy, and I'll talk about that again in the European Union. And that just shows you how bureaucracy sometimes get its own way. They negotiated too hard with the drug companies, and they were unable to get all the contracts done. They signed with AstraZeneca, only one company, and they're having issues with that. I'm going to talk a lot more about the tax proposals and the Biden tax plan at the webinar, get into a lot more detail, but how much EPS, earnings per share, does it take away? Each one of these, what is the expectation for earnings? And you know, you've heard me for 30 years say, earnings is what drives the stock market. The more money a company makes, the more valuable their stocks are, the more the price of that stock goes up. So what we're looking at, if we do get all the tax proposals done, it takes away about somewhere around 9% off the S&P earnings, not the market, but the earnings. One of the ones that are more affected are information technology, consumer discretionary communication services. Some that are less affected than that are financials and energy. And that's why we've seen a tremendous rally in these markets. So I'll show you what happened last year, where they are this year, what the sectors were last year that did not work, and what the sectors are working. One of the things that are 2.2 standard deviations is interest rates. Everybody last month was all worried about interest rates. Oh my God, rates are going up. They're killing the economy. Folks, we're at 1.65% approximately for the 10-year. It's not the end of the world. I will show you exactly the last data going back from 1960, I believe, to 2009. Where did interest rates go to the 10-year before they had a negative impact on the stock market on a quarter-by-quarter basis? And from 2009, where did interest rates go, and what point, the inflection point, do they have to get to where they start having a negative impact on interest rates? I'll show that chart to you in the webinar. That's next Tuesday, but let's take a look. I don't have a time to go through all of that today, but we'll spend an hour and a half going through all of that. Second standard deviation, when we get there, interest rates hit a peak and start coming back down. We've seen this. We got up here. This was 2018. Rates came down. Came to here, and rates came down. Question is, we've started to go back up. We're nowhere close to 2 standard deviations, which would put us somewhere around 1.9 to 2% for the 10-year. I still think we can go there by the end of the year. It will not be the end of the world, but that will be a 2 standard deviation event, which is just about as far I think it'll go before the Fed starts to come in and put risk control or yield control measures in place. Again, how did yield control measures work, and what will they do to interest rates, and how that will impact the market? discussion for Tuesday night. Let's take a look at the technicals, the language of the markets, as I call it. I do a section every day, which I've done for 30 years in the daily broadcast, because that's what I enjoy doing, looking at the technicals. We look at Elliott wave. Here's the S&P chart. You know, I had a 4,000 target that I put out a few weeks ago. Well, you've got to look at that in the rear view mirror. We're nearly at 4,100 today as of the close. What is the next target if we do get an extension on the fifth wave? This is the projection. Doesn't mean the market has to go there. These are my opinions. This is the way I'm looking at it. Short-term target 42.35 is where the S&P is looking. We might get a little bit, we're getting a little bit overbought in the short term. Could see some backing and filling, but that's just going to be the pause that refreshes the market. That's the way. It's like a runner. When they go on a sprint, after you sprint for a while, you've got to slow down to catch your breath, and that's what the market is looking to do. Weekly charts, obviously the numbers are more higher. Each one of these red and green lines is 1 week of trading rather than the previous chart where it was 1 day. This is 1 day of trading, the daily chart. And this is 1 week of trading where each one of them going back to 2017. We saw everything moves in 5 waves, wave 3, wave 4, wave 5. Once we complete 5 waves, we get an A, B, C correction. That was the last move. Now we started a new wave count. 1, 2, we're in wave 3. 3 is the strongest wave in the Elliott wave. We're in that. That's where you get most of the gains in the market. That's what you want to get hold of somehow, the third wave in a market, and stay with it for as long as possible. Then we'll get a fourth wave correction somewhere, probably over the summer. You know, we get the fourth wave, the sell in May and go away. We might get that, and then we start the fifth wave. Or it might elongate to next year before. This is a weekly chart going back about 4 years. So this is a longer term perspective. NASDAQ got above the 50-day moving average. We completed the ABC after the fifth wave, the A, B, C correction. Now we're starting a new wave count on the dailies. 1, 2, and we're getting into the third wave. We have not made new all-time highs. That's 14,175. Today we closed at 13,829. So we're getting there. But now the short-term target, once we get above this resistance, which was the previous high that we made in February, once we get above that, we start looking for the third wave move to the upside, and that's where you get the bulk of the move. We had some people worried about interest rates going up and hurting technology. Well, interest rates have calmed down, they've stabilized, and that's why we're seeing the technology starting to move up to the upside. Looking at, this is the pivot points, these little dots that you see underneath the charts. This is a weekly chart, 1 week of trading instead of 1 day. When these charts get above, these little dots get above the market, these are market prices, you can see we go down for 5-6 weeks. When we turn up, we usually turn up for about 10, 12, 15 weeks on the upside. We turned up here in March, went up all the way into September of last year, August of last year. Then we had about 4 or 5 weeks of down, and then we've been up. February, we hit a high, and we had, and when that started to happen, I said, look, we could get 4 to 6 weeks of down. We did. Now this week, we gapped above the pivot, which was 1627. We gapped above that, and looks like we're headed. The weekly target now is 16.4. Again, that is just technical projections, but you're in the third wave. When these turn up, when the dots get below the market, and you will see this dot next week when I do this update, you will see it'll be below that. It'll be down here rather than be up here. And that's where we think it'll be down here somewhere rather than above the market. So that's technically what we are looking at right now. Resistance was 13,627. Now we're looking at the all-time high, 14,175. We're only about 400 points away from that now in the NASDAQ. Once we clear that, I think we're going to see more and more momentum building to the upside. Short term, will we get there before we get to May, or could we just continue just in May? It's a seasonality, doesn't mean it's going to work this year, so we have to keep in mind. Gold, which has been very disappointing, has come down, but it came back up today and tested the resistance area, which is what we're seeing right now. 1765 is what we're looking at as resistance. Today's high was 1759.4. That's where we got to. And now we're going to see if it can get through the 50-day. If it does, then we could see it move towards the 200-day. But I'm just not as excited about gold. As you know, we haven't had any gold in our portfolio, even though I started my career as a gold trader in the 70s. You know that. So I think gold is in trouble, especially if it breaks this support at 1675. We came and tested it, held it, but if we break below it, next support is about here, which equates to about 1600. And if we break 1600, no support until we get to down about here, which is about 1450 to about 1400 is what we start looking at then. So gold, I'm not a big fan of. A lot of the younger people that I'm talking to, they're saying, why gold? Why not buy Bitcoin? It is becoming a separate class, Bitcoin by itself, and crypto. And I'll get into a lot more detail on crypto at the webinar, because I think that's something we have to really start paying attention. It is becoming something, but will it replace the dollar? I don't think so. I'll talk about the Chinese digital Chinese yuan, that the Chinese have launched a digital currency. What does that mean? We're working on the digital dollar. I'll talk about that also at the webinar next week. Emerging markets, we saw a third wave high, fourth wave pullback. This looks like we've completed the fourth wave. We're starting to get to resistance, which is about 44.71. If we can get above the 50-day, then we go towards resistance, which is this high. But the target for the emerging markets is way up here, around 62. That's what we're looking at right up here. So will we get there? I think emerging markets, they're falling behind a little bit because they're having problems with getting the vaccine. But once we by the end of this week probably, or by the end of April, we're looking at producing 30 to 50 million doses a week. Everybody here will be vaccinated, so we will have that access capacity to really help the world. And that's where we will have vaccine diplomacy really taking effect, and I might get into detail, but we need to help some of the countries, help Europe, and then again, in return, we might get Europe cooperating more with the United States, working against China, or against making sure that China starts to follow the global rules of trade. And that, I think, will set up something of a dynamic where the Chinese might say, okay, let's start working with the rest of the world. The Russell small cap completed a fifth wave. We're in sort of an ABC correction. We're still at the 50-day today. We need to get above this decisively. I think we got a little bit more of back and forth. These waves are fourth waves or ABC corrections. Take a time to develop. I believe as we go, small cap is losing some of its momentum. It's still the leading index this year, but we are starting to see some loss of momentum. People are going back towards the large cap again. We saw Amazon. I've talked about that on the daily broadcast. I gave you a number where I thought was support, and I gave you a target on that also. I think we're going back towards large cap. I believe both indices are going to do well, but small cap is, I think, a little waiting. It's got a little bit more work to do because we had this tremendous rally from in the last 3-4 months in the small cap. So we're looking at that. Here's a weekly chart. Each one dot is 1 week of trading. Targets are much higher on the weeklies. So in essence, what we're looking for is much higher prices in the market. Doesn't mean it has to happen, but that is my view. Those are my opinions. That's the way I'm looking at the charts. You have to do your own analysis, and I'll show you how you do that to find the right mix of assets. Not all technology, not all small cap, not all reopening. Having the right balance is what creates wealth over a period of time. We'll show you that roadmap in the webinar next Tuesday night. Again, that's next Tuesday. Go register right now. Go to compak.com and you can register on the 13th is when the webinar is. I've changed the date. Initially it was 14th. And now I'm going to do it on next Tuesday on the 14th and on the 13th. So make sure you are there at 6 p.m. Pacific time. It's live. I'll answer your questions live on the air, anything you want to know, and I'll try to answer as many. And hundreds upon hundreds of you are going to be on the webinar. I'll try to answer as many of those questions as I can. That is my view. That is the way I'm looking at the markets today. New all-time highs in the S&P today. So I hope you're enjoying your allocation, enjoying being in the market with the right mix. I will be back with you next week. I'll see you Tuesday night. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.